Welcome back. We're talking about taxes today. We're coming up on November and December.
Taxes, yuck.
Right. I was saying earlier, it's a five-letter word that feels like a four-letter word. I'm not sure. Yeah.
It should be something like that, like tack, like stick.
Yeah, right.
Stick you.
Poke you with it.
Right.
With it. So we've been talking about taxes, and we don't want to touch on another one that not everybody has, but is interesting if you do have it. It's called an HSA, a health savings account. And these, the only way you can get to one of these accounts is through your employer. You have to, or having a high deductible plan, I guess.
You have to have a health insurance plan that qualifies for an HSA. And I think we have to make a distinction between an FSA, where so a lot of people are familiar with that, whereas this is a HSA.
Yeah.
And it's there's there's different requirements on both of them.
Yeah.
And we like you could have both technically, but most of the time you don't. Most of the time
and the HSA, it's healthcare only, and that's the whole point. So if you have a healthcare plan is qualified as a high deductible plan, there's some rules of what you have to do. But basically, if you have a high deductible, they say, well, we're going to allow you to have one of these HSA, health savings accounts. And the benefit of these is you put the money in pre-tax. You get paid for your employer.
You get tax deduction for it. Pre-tax is code word for you get a deduction off your income.
Yeah. So you put it in there, and the money goes to this account. And then it sits and it grows. It's invested. It grows over time. You don't pay any taxes on that growth, which is great. And when you take it out, here's the kicker.
If you use it properly.
You take it out and use it for medical copays,
prescription
drugs, medical procedures that aren't otherwise covered. If you use it for stuff like
long-term care insurance premiums.
Oh, that's a big one.
Yeah, that is a big one. So if you have long-term care insurance, you can use your HSA to pay that.
Yeah. So if you use it for any of those purposes, when it comes out, there's no tax there. That's the kicker, because retirement funds, you put them in, you get a tax avoidance.
So wait a minute. So let me go over this now. So I get a tax deduction for the contribution.
Yep.
I can invest it so I get tax deferred or tax-free buildup of my holdings.
Yep, it grows.
And when I take it out, it's also tax-free.
Yep, it's not part of your income.
Can you tell me any investment out there that gives me all three of those?
That's great. That's the amazing part of these HSAs. So most retirement accounts, qualified retirement accounts, give you two of those, right? It gives you the reduction on your taxable income when you put it in, gives you tax-free growth. But when you take it out, it's income.
Now, again, I think they're prejudiced against older people, because once you get Medicare age, no matter what your health insurance plan is, you can't contribute to an HSA. I get a lot of clients who are beyond 65 and they go, well, can I do that? I'm saying, no, sorry. Even though you're still working, even if you have the right health insurance plan at work, because now you shift to Medicare, it doesn't make any difference. I've had the arguments all over the place. And believe me, you're preaching to the choir when you're talking to me about it, because I'm over 65.
Yeah.
So I love HSAs. I think they are a phenomenal tool, and we try to encourage people to use them. But the issue is it's got to be tied to a qualified health plan, right?
You have to have a qualified health plan, and it takes planning.
Yes.
This isn't something that you can say, hey, I had a good year, let's put $20,000 into this. I'm going to fund my copays and fund my medical for next decade. You can't do it like that. It's a little bit each year. So for a single person, it's $3,650. That's all you can put in. For a family, which is most what people are trying to structure this with, $7,300 each year.
So they limit the amount that you can put in each year, right?
Yeah.
Are there income limits as to when you can't put it in?
It's a good question. I don't know of any. I know that it was as long as you have the right plan, you put it in, but that's something we'd look with each person, right, to make sure they qualify. But the idea being that if you put this in 1 year, doesn't make a difference. 2 years, 3 years, 4 years. If you do this consistently, and the money is invested.
We have some clients that have literally over $100,000, $200,000 in their HSA account,
which is shocking when you get there. And, and you say, exactly. How did you do this? And it was consistent planning, knowing that they didn't need to use it at the moment. They let it grow. They let the investments run with it. So now that they're a little bit older, they've got regular copays. They've got regular prescriptions. This money is money that they never paid tax on years ago.
And we look at it from that standpoint. They have built up a plan that help pay for their long-term care needs, if there are any.
Yep.
And again, it's the triple benefit of all three of those tax benefits that money can go. And when it gets paid out, no taxes.
Right. And how many people would love that, to say, I can avoid taxes now when I'm younger, and then when I'm older and I need money, I can use it tax-free. It's a great process. But again, it's something that you have to make a strategic plan and lean into. So for people who can shift to a qualified health plan, it makes sense for their life now, get an HSA and start that process of putting away this money and getting invested.
Yeah.
It's a great way to go.
It's an amazing instrument. And again, getting back in comparison, an HSA to, you can accumulate it. So if you don't use the money, in other words, if the money just accumulates, it goes from year to year. It builds up just like an IRA account or any other investment account. Whereas if you have an FSA, a flexible savings account, you have to spend all the money that's been
Mhm.
allotted to you by the end of each year, whether you use it for childcare or some other benefits. Whereas an HSA, you can accumulate. If you don't use it, it builds up over time, and it's your money.
Yep.
And that's a big deal in
It's
my
a big
mind.
deal, right? And knowing that healthcare costs as people age are not going to go down.
Yeah.
They're usually, very, very, very commonly they're going to go up, and having
Right.
as a resource is great. So we talked to, 401ks, IRAs, some other tax items. The last one will be just bonuses. If you're going to get a bonus, if you're going to get any sort of end of year additional compensation,
Right.
this may not be the year that people get bonuses, but if you do, it's a good moment to think about how much of that bonus should go into your pocket, pay taxes on it, how much of that bonus should go into your retirement.
So if I'm going to get a bonus in December, let's say I'm working for a company and they regularly determine my bonus and I know what it is, but can I use that to max out my 401k then?
Yep, you can. So say you're going to get a $5,000 bonus, you look at how much you contribute to your 401k and say, oh, I could avoid the income. I don't need the cash flow at the moment, and I can put into my retirement. And someone who's in their 20s and 30s, it's a huge benefit. It feels harder to them, right?
Right.
I want the money.
More.
I'm not going to see this for years, but that's a huge boost to their future self. But someone who is a little older, they see the benefit. Oh, I'm going to use this money, in a number of years, and I can avoid the taxes now. It's a great moment. So what you do, you talk to your employer and say, oh, I'm going to get a bonus. I'd like to change my contributions to the retirement plan.
So we have a lot of conversation about whether you should go into a traditional plan or a Roth plan. Now, most 401k plans will have a Roth provision. That just means that if you're getting a bonus, whatever that is or whatever you contribute to it, you're going to pay taxes on the contribution. Now, the advantages of a Roth, of course, is that you don't pay any of the gain. You don't have any taxes on the gain. And the distributions later on in life, it's all going to be tax-free.
Tax-free,
all
right.
tax-free. So it's a different as far as the deductibility at the end. But most plans will have, like on a 401k, you can do a Roth. You can do a Roth. You don't have to do in what I call a contributory plan, or where you're just getting the deduction for it. Right. So depending on the age and the circumstances, we've got some personal philosophies regarding Roth. I think you look at it slightly different than I do.
Right.
I look at it as you want to use the tax deduction dollars to build your retirement account up. Once you've reached that level that you feel comfortable with the dollar amount you've accumulated, then you switch to a Roth, because the Roth is going to give you a better tax cash flow later on, right?
And often we'll talk about Roths, and one of my perspectives is that they can double as a college savings account.
Yeah.
You put money in there, you do it when you're younger even, let it grow. And if your kids go to college, hey, that's what you use the funds for. If they don't, you use it for retirement.
There's so many programs that you need to know about in all these little increments. And that's what we do, is we sit down with our clients and help them through the process of what can you use, what can't you use, how do you maximize, how to utilize it to reduce the taxes, because you're using 100 cents on the dollar. For everything dollar you make, you're getting that into your retirement plan for later use, right?
Good one. Yep. So November, it's a good time to check this stuff out, look at your finances, see where you're at. If you missed any part of this episode, you can go to our website, retirementunlimited.com, and catch the whole thing, or you can catch us on YouTube. You can also give our office a call. It's 951-684-7011.